next speaker is Mr. Siddharth Shetty. He's the co-founder of Sahamati and the advisor to the Indian Ministry of Finance on DPI. Siddharth.
Hey everyone, I'm Siddharth, and what I would share with you today is our thinking around how did we approach the question of giving individuals and small businesses control of their data, right? How do you give them control? What does that mean from a governance standpoint? What does that mean from a technology standpoint? What does that mean from the institutional setups that need to be created that ensure that every citizen in your country is truly given control of their data? For us, this journey started off in 2016 when we realized that within India, a lot of people were becoming data rich, but the paradigm was very different. Unlike traditionally advanced economies, when their individuals became data rich, they had higher amounts of discretionary income, money to spend, and therefore data was fundamentally used to shape those spending patterns. So you had companies created, they would consume the data, target ads, earn a commission on those ads, very large and profitable business models. So it was fundamentally an ad-driven economy that got created around the internet. In India, given that most people didn't have high levels of discretionary income, it became important to invert this paradigm, where data, instead of just being used to sell things to the user, is actually used to empower them to access better credit by eliminating the information asymmetry gaps that exist in these ecosystems, bridge trust, access better health services like telehealth, remote healthcare, and other socio-economically important services. And so fundamentally, we've been looking at data from the lens of data protection, but equally as important from the lens of data empowerment. Now, when we think of designing any of these ecosystems, and I know some of you are central bankers, some of you are running regulated institutions and are from other parts of the government as well, there are different questions that come up. On one end, you want to ensure that your citizens have access to these ecosystems. They have access in affordable ways such that it's democratic and available to all of society. They have choice in that access, so they can choose different market players to go to, and they have agency over their own data and digital lives. But then on the other end, as regulators and nation states, you have other objectives that also come into play. How do you ensure sovereignty over the infrastructure that's being created? How do you ensure it's a level playing field and monopoly effects are taken care of? How do you ensure privacy and security are embedded within these very ecosystems that are being designed? And so therefore, you're trying to balance between these nation-state regulatory objectives and the objectives of the end individual that we need to serve. And so really, as we thought about this data economy, the question we asked ourselves is, how do we create a playground where regulators can regulate and innovators can innovate? How do we embed governance at multiple layers that opens up this ecosystem to all? And that's really what the data empowerment and protection architecture is all about. Now, very briefly, we approach this from three angles: the angle of technology, the angle of governance and regulations, and the angle of institutions that needed to be introduced to make this happen. These are India-specific developments. I'll sort of go over them at a very high level and then contextualize it in a way that you understand how it's been fitted into the architecture that we've designed. On the left-hand side were technology standards, and that's what you've heard today in the world of ID and then education. So when we thought about data sharing, it became extremely important that you lay out tech standards that ensure interoperability. So tech standards for consent, right? Otherwise, you have different types of data, different meanings of consent. You know, what is consent? Who gave the consent? For what purpose? For what time period? Different sectors would have different interpretations. So it became important to standardize consent, and we standardized it and created a national standard around that. It became important to standardize the pipes within which data flowed. So for example, let's say I wanted to apply this to the financial sector. People can give consent using the standard, But then the banks have to participate. For them, they have to plug into some sort of pipe. And if you don't standardize the pipe, everyone has their own proprietary connections, and this doesn't scale. Now, the pipe cannot be sort of designed based on the data, because you would want to pass banking data, you may want to pass capital markets data, you may want to share government data or health records. The pipe shouldn't change. So we ensured that in the technical standard, the pipe was sector agnostic. The only thing that changed is the data that went through that pipe, flowed through that pipe, and that could be a bank statement, that could be a tax record, that could be a government credential, so on and so forth. So a bunch of work went into creating these very minimal technical specifications that then got adopted by the regulators and also by the legislators into their sectoral regulations and into the law. So very recently, India's parliament passed, after a lot of years of consultation, the Digital Personal Data Protection Bill. The essence of that bill is they really took this entire approach of giving people control with consent, embedded that into the legislation, and also embedded, for the first time, this construct called consent managers. So they said, where do people go if they need to give consent? Many of your countries also have privacy bills. Many of those privacy bills, much like GDPR, are based on the idea of consent. But how do you operationalize consent? And so that's where, in the data protection bill, they introduced this new entity called consent managers, and that's where people or small businesses could go to actually grant consent and then facilitate the rest of data sharing. And then you had sectoral regulators, like in India's financial markets, we have a central bank, we have a capital markets regulator, an insurance regulator. So each one of them published their own sectoral regulations, adopting this framework and directing their market players to participate in this. So you have technology standards, you have policy frameworks. The other question is who rolls this out? And so that's where the institutional setup became quite key. You needed to bring market players together, large banks, small banks, fintechs, public sector, private sector, asset management companies or government departments. And these are often, if you take a look at it, even within the private sector, traditionally these are companies who compete with each other in the market, one bank versus another. But for this ecosystem to succeed, they had to cooperate. And only if they cooperated would the market expand as a whole. And so therefore we set up Sahamati essentially as an institution to facilitate that cooperation amongst otherwise competing players in the market. Along with Sahamati, of course, you had this construct of consent managers that got introduced, and these are market players that are going out and facilitating and creating those consent experiences. So how does it work? If you think of traditional data sharing, what do we do, right? On the left-hand side, let's say you have custodians of your data. It could be a wallet company, a bank, a mutual fund, a tax authority. What's a typical experience? You would go to the branch. So physically, citizens would go to the bank branch, take out printouts of their data, and then create a folder and take that folder with them when they want to apply for a loan or they want to apply for any other socioeconomic service. Alternatively, instead of running around physically, because imagine you had 2 bank accounts or you had 1 bank account, 1 mutual fund account, and so on, or in healthcare it becomes even more complex because over a period of your life you'll go to multiple healthcare providers. What do? They'll digitally go to these different portals. So that same physical experience, they're now running around to different portals and taking downloads of PDFs, right? Putting in some complex ID, we don't remember the ID number, logging into those portals, downloading PDFs, creating a digital folder, and then taking that digital folder to the lender for them to underwrite. And so this is a very, very broken, fragmented, not privacy preserving at all experience for citizens across the world, including India. So we felt if we had to give people control of their data, and if that control got operationalized with consent, they should go to one entity, that is their fiduciary entity, with whom they could manage their consent, grant consent, and do all of these actions. And so those entities became consent managers. Now I'll talk you through a real life example of this, where it's being operationalized within the financial sector. And then of course you can generalize this to health data, telecom data, and other types of data as well, government data, and so on. So within the financial sector, consent managers are known as account aggregators. That's just a very technical term, but for all practical purposes, they're consent managers. So on the left-hand side, you have banks, you have all of these institutions, they're storing data, and data should be decentralized. We don't want to create one centralized repository of all of the citizens' records. No, that's not going to work. On the right-hand side, we have entities that want access to that individual or small business's information. They may want access to underwrite for a loan. Today, in India, for example, one of the biggest problems is access to credit. Only about roughly less than 10 to 14% of our small businesses have formal access to credit, right? Can we scale that up? Similar numbers when it comes to individuals. Today, we have very limited retail investor participation in our capital markets. Can we scale that up? All of that comes on the back of data. Can I lend instead of physical assets? Can I lend on the back of digital capital? For that to happen, for all of these entities on the right to get access to that individual's data, that individual can use these consent managers. So this ecosystem adopted those technical standards I spoke to you about of consent, pipes, data. Data remained at source, always decentralized. Identity is federated. So you heard about Aadhaar earlier today, but actually in this ecosystem, we don't use Aadhaar. So identity is federated. The principle was very simple. The individual should be able to create a unique / unified view of their information, but no one in the system should have a unique view of their data. And so one of the myths often when we think about data sharing is this question that I need a unique ID, and only if I have a unique ID can I do data sharing. No, that's absolutely wrong. As long as you give power back to that individual, they will aggregate their data. And they may aggregate a subset of their data. That's perfectly fine. They may not want to share certain health records. That's perfectly fine. And so in this system, data remains decentralized, identity remains federated. In fact, it even made the adoption easier because many sectors, that information was not even linked to the unique ID. And we would have to go through a whole circuitous process to make that happen. Now you could readily fold those sectors in using whatever ID customers had already used with that financial institution. So an individual goes to a consent manager, discovers where all their data resides, links those accounts. Now I've linked my account, say one bank account, one tax account, one mutual fund account. Now I want to share my data with the lender. So I go to the lender, I give them my account aggregator ID, say Kamya@AA. And so now the lender says, okay, in order to assess you, understand your cash flows, I need access to your data. For that, I need your consent. So I give them my AA ID, Kamya@AA. And then in real time, the lender would send a consent request. And that consent request pops up to the user, imagine on your app. But this doesn't only work if you have a smartphone, it also works for feature phones or those who don't have a phone in an assisted manner. But let's say you had a smartphone. So that notification pops up on your app saying, hey Kamya, this lender is asking for your data for this purpose, for this time period, so on and so forth. Do you authorize it? And if she says yes, in real time, that consent is sent to those financial institutions, and they send back digitally signed data, machine-readable data in an encrypted format. So these consent managers, I think of them just like postmen. They can't see the data, they can't store it, they're just facilitating the flow of consent and then the flow of data. And you have multiple consent managers because you'll want different user experiences to be built out, either for individuals, either for small businesses, so on and so forth. And so this is just one example of how that consent request looks. It's a very informed request, and informed, of course, will vary based on the context of that individual, either based on language, based on the medium with which they're accessing this service, so on and so forth. But this is just one example. It says what data is being asked for how long, what is the frequency of access, is it revocable? It's very granular, and then the user can approve or deny it. So for many countries that actually have privacy legislations that talk about informed consent, this is actually bringing informed consent to life, depending on that segment of the users that are accessing this. I have a quick demo of this. I don't know if that can be played. So this is a real demo of account aggregator in action. Bajaj Finserv is one of the lenders. They are a non-banking company. And so an individual goes to this lender in a completely self-service mode and wants to access financing. So the user signing up with the lender saying, okay, I want X amount of rupees for Y years or months. And now at this point, traditionally the user would have submitted physical documents, uploads, or given their username and password to share their bank statement. But this is where account aggregator comes in. So the user selects account aggregator. OneMoney is one of the account aggregators in the ecosystem. Like I said, there are many. I can see my accounts, and now I'll link my bank accounts. Since this is the first time I am setting it up, once I've linked it, I don't have to link it again. So I've linked my State Bank of India account, for example. State Bank of India authenticates me to then authorize that linkage, all happening in a very convenient manner for the user. And once I've linked my accounts, this is the consent request that I see. This data is being asked for this period, this frequency, and I can approve or reject it. If I approve that consent, that data is shared. Bajaj Finserv does a real-time underwriting, gives me a loan offer, and I can proceed with the rest of the disbursement. In this case, what you're seeing is UPI being used to then disperse the money into that bank account. So there are many lenders. We can go to the next slide. There are many lenders that are using this ecosystem. So over 400 plus financial institutions are now on board across public sector, private sector, and not just lenders, but even insurers and pension funds are also participants. And these same principles are what's also been applied for unlocking government data. So what you saw was within the financial sector, but DigiLocker is doing the same, unlocking government credentials, either issued by state agencies, by central agencies, other departments, like your certificates, your licenses, your mark sheets, are being unlocked through DigiLocker, which follows the same principles. And the ghost is changing it again. Could we go to full screen, please? And now with the recent passage of India's data protection bill, this is also being applied to private data. So you could imagine data on e-commerce platforms, your transaction data with other private sources. All of them can now be participants in the system beyond just traditionally regulated sectors of finance, health, telecom, education, and skills. And so really what you're bringing together is the power of the market. Like I said, there are over 400 plus institutions that are participants in this network. You're bringing together the power of open technology standards and then the right governance arrangements. And these governance arrangements are across all the three levels: your legal frameworks, your subsequent regulations, and then your contractual norms that the actual market players get into. And so what we're doing is we're embedding governance, because the only way this can scale is if governance is embedded at every level of the ecosystem across what the technology standards are, what the market players do, and then of course when things go wrong, the regulators have a framework to step in. What's also important, if we just look at the financial sector, and there were some questions on financing before, this entire ecosystem was built on zero Zero government spend. The government did not have to create a budget for this. All that they did is recognize open standards and thus ensure interoperability, and then create the right regulatory norms within which participants could interact. That's it. They, in fact, did not even mandate participation at all, and they had to create no infrastructure, spend completely zero, yet you had 400 institutions coming on board. And so especially when you think about digital public infrastructure, yes, in certain ecosystems like ID, which has a sovereign function, there tends to be a greater spend. But in a lot of other ecosystems, you don't have to financially spend. It's how you design the approach that is most important. Just to give you a quick overview of the ecosystem in India itself and how it's manifesting. So far, over 1.9 billion accounts have been enabled on this ecosystem. And these are financial accounts. So not just bank accounts, but like I said, this is cross-sectoral. So accounts from capital markets, accounts from insurance, and many other financial sectors. Now, because the technical standards were designed the way they were designed, we could add a new sector or a new account type without any change. So very recently, we had GST, which is the tax network in India that businesses use, small businesses. We have 14 million small businesses part of it. GST went live as part of this ecosystem. Again, with no change in the base technology framework. We've had about 25 million successful consents that have flown through the system, and it's growing about 20 to 30% month on month. On the left-hand side, there are over 100 financial institutions live as providers of data. And why are they participants? Why are they even thinking of participating? And these are all the large banks in the country. A public sector bank that holds 500 million accounts, the largest private sector banks. Because often the question is, why should I give my data out? And fundamentally, what we are seeing is when people participate in these ecosystems, this expands the market as a whole. And when it expands the market as a whole, if I'm a bank, at the end of the day, I'm actually making money from credit. I'm not making money directly from data itself. So if I can expand the market, I can lower the transaction cost, I can bring in tens of millions of small businesses or hundreds of millions of customers who couldn't access credit before into the formal ecosystem and lend to them. And so that market expansion is extremely key because we fundamentally base the entire rollout on that. Not on a compliance-driven model that we are enforcing this, you have to follow it, if you don't, we'll penalize you. It was fundamentally on a market incentive-driven model that got all of these players to participate. Otherwise, they would resist. And they're large enough to actually push back and stop the system, and we would have none of this. Similarly, you have a whole range of players that are live as consumers of data across lending, pensions, insurance. Different types of use cases are coming to life. And again, it's a healthy balance between incumbents, fintechs, newer companies, innovators that are coming in within the ecosystem. And just to run you through, as this rollout has happened, what has been the impact at a micro level? Just one example, one sector of data empowerment in action, and how does that impact both individuals as well as the institutions that are participating? Because many of you, as you attempt some of these projects, the key question that comes back is, what's in it for me? What's in it for me either as an individual or as an institution that you're asking to get on board? So within the lending space, we have categorically seen a greater expansion both on their top line, so higher net interest margins, better growth rates in terms of advances to their customer, a reduction in their cost to income ratio because now I'm getting data directly from source, better NPA performance because now I minimize the fraud, I can lend to retail segments in a more reliable manner, I can monitor much better because I can give consent on a recurring basis so they can monitor my cash flows, hence better NPAs, hence lower credit losses. And these are just some examples of lenders that implemented this ecosystem. This was one of the large private banks Very small implementation. They probably introduced this in like sub 5% of their customer base for an auto loan. In that sub 5%, they saw a cost saving of greater than $1 million, 20% growth in the advances to that base because it's a better customer experience. Fraud rates, which are typically in the range of 4 to 6%, dropped to 0, and the application time went from 30 minutes to sub 5 minutes. Similarly, for an MSME loan, a very similar set of, I would say, developments. Consumer acquisition costs dropped by 25%, their advances increased by 30%. Turnaround times traditionally would have taken 24 hours because this was a phygital flow. Someone going to a bank branch, applying for a loan, traditionally they would have given physical documents. Here they shared it using the account aggregator. That turnaround time dropped to less than 30 minutes. And then a fintech that also used it, they saw a greater increase in customers that completed that flow, over 35% than traditional flows. So what you can see is at a very micro level, this is impacting and benefiting each and every institution, agnostic of their size, that's participating in the ecosystem. And these are the market incentives that really drive the pull in any of these large-scale rollouts. And not to bore you with the numbers, but this is an assessment we did with one of the large private sector banks in the country that roughly showed if they participated in the system and implemented this across all their workflows, they would add roughly about $8 billion to their profit after taxes. So data sharing is fundamentally very valuable to all the participants in the ecosystem because they can create newer financial products. From our vantage point, that benefits inclusion. Similarly, we'll send you the slides afterwards, but there are use cases in the insurance segment, as well as we saw life. This is an interesting lens from an inclusion standpoint. Traditionally, for self-employed customers, this insurer was insuring about 20% of their base. When they used this infrastructure, that jumped to 40%. And then for low-income customers, they saw a 7x increase in the addressable market, again, because of account aggregator. And then capital markets, similar experience. And so what we've also been working on quite heavily is working with the international ecosystem. India recently culminated its presidency of the G20, where one of the key three DPIs, of that three, one was digital ID, the second was real-time payments, and the third was really consented data sharing. And so we've been working with a lot of international stakeholders to actually realize this goal of consented data sharing, not just in India, but across the world. These are some papers that have been published, so you should definitely take a look at this. And yeah, that's about it. Happy to take any questions.
Thanks a lot.
All right, thank you so much. So much to learn and so much to, gain in the shortest amount of time. So please, we'd like to have all the slides, starting from the first course to this third one. So I have so many questions because this is something we're currently doing right now, at least with Nigerian National Switch. And there are so many issues that we've encountered, and I would like you to please, if you could explain how we can deal with it. So we are like a data aggregator right now, and we have some information from the various financial data providers, and there are some people that we are looking towards them also giving us this data. We already have some from the banks and from various institutions, but we want to have more of this data so that we can provide a true and open banking platform. But there's reluctance from some of the will I say, sister agencies. So how have you been able to, get everyone to provide this data to this aggregator so such that consumers can seamlessly access it from them? So that's one. Two, so one of the things we've experienced is we provide this data to the consumers who in turn store this data and then don't come back again to ask for it because they already store it and they market this data. So how do you digitally, sign the data or lock the data such that if I give it to you, you can't reuse it for something else and you can't ever store it. How have you been able to achieve that? And then lastly for me is, do you have just one data aggregator, or are there so many? And if it's just one, or I'm assuming that this digit locker that was workshop was is an app for this giving consent. I just want to know if you have one or you have so many, are they using the same app? And how have you been able to tie it to various consumers who want to give consent? So is it tied to their bank mobile app, or do I have to go to the app of the data aggregator to go give consent? Thank you.
Very good questions. Very, very strategic questions. So if I answer the first one, I'll just go back to this slide. Okay. Yeah. So your first question was a question of incentives, right? You will have some institutions that may resist because the question is, what's in it for them? Why should they participate? And how do you, when you have these silos, bring it together? Now, that's a complex question, so I'll answer it in a few dimensions. One, we said let the silos remain. So everyone needn't come to the same table. Because if we expect all these financial institutions to come to one common table and then discuss this, you'll have chaos. And we saw that chaos in the early days, right? Because you'll have big banks, small banks, network aggregators, you'll have fintechs, and everyone has slightly different optimization functions, right? So it becomes very chaotic, finger pointing, all of that stuff, right? So we said, let the silos remain, but design an architecture where the individual is able to bring it together. The system doesn't have to bring it together. The individual, using these protocols and using these regulations, the individual can bring their data together. That was one key design decision. The second decision at a market incentive level is we said there should be a principle of reciprocity. So if you want to access data using this ecosystem, you have to be a provider. So Sahamati, which is the market collective, came up with this principle. So now many of the large entities also want to access data because they want to give credit, or they want to manage your wealth, or want to sell you other financial products. So we said if you want to access data, you have to be a provider. Now this is not new in the financial markets. In fact, and you can draw analogies to the card networks, right? You mentioned you were a network operator. I'm sure you have a similar principle where if you want to be an acquirer, you have to be an issuer. Or if you look at credit bureaus as well, unless you report data, you cannot access from the credit bureau system by and large. So this principle of reciprocity is well established within the financial markets. We just applied it to data sharing. So that was the other aspect that came in play. The third aspect was the creation of consent managers. So otherwise what would have happened, and this is what happens with traditional open banking rollouts, where you don't have consent managers, all of these banks have to talk directly to all of these entities here. And that becomes very problematic, because then they start saying, who can they talk to, how are they being audited, what are the security norms, whole bunch of lists. So we said, all you need to do is, as banks or financial institutions, you just talk to these regulated intermediaries. That's it. Now from here, who the customer wants to share data with, that's their question, not yours. And that unbundling became very key. Because then the banks only became concerned about, okay, these class of entities. They didn't start asking questions about these. Of course, you have broader questions. How do you ensure data governance and things like that? But by and large, these consent intermediaries played a very key role in then ensuring that the banks or whoever else are custodians of the data were very focused. Then what we also ensured, which are the slides I showed you by design, was that if you participate in this system, this expands your balance sheet. this expands your assets under management. So even if you are a large incumbent player, this actually benefits your ecosystem. And again, this is not new. If you would remember in Nigeria, do you have credit bureaus, for example? Right? So imagine pre-credit bureaus, everyone would hold on to their liability data, right? Only I know who I've given a loan to, no one else should know. What happened in that case? The borrower would go to multiple places, take out multiple loans, and that assumption that this is proprietary information actually hurt the bank because the borrower would go into debt, over indebtedness, and can't pay back anyone else, and also become a systemic risk. So therefore, with the introduction of bureaus, which was the first example of collective data sharing, right? You had the banks share their data, benefit from that because that expanded the retail credit market. Now you're just extending this to other categories of data. So some of the banks have that lived experience, you have to tap into that, right? Collectively, we've seen in financial markets, when you cooperate on this base infrastructure, it expands the market as a whole, drives inclusion goals, but also profitability for them. And lastly, two more things that we did. One, at a pricing level, the regulator did not say you have to do this for free. So again, unlike other ecosystems, the regulator left it to the market to determine. And of course, the market will determine some price point based on ensuring affordability, inclusivity. You don't make it so expensive that the customer is priced out. But fundamentally, for the work that you're doing, you can recover a cost, right? So that made it broadly comfortable for them to participate. And today, they're already sharing data. Think of it. They already share your data via a portal, right? Or they send you statements which are even more expensive to your house via post. Now they're just doing it in a completely digital manner. So it's not costly at all. I mean, it's probably like less than a few $1,000s, the average cost of implementations. Of course, that is because that's now scaled and matured. But that's roughly the range we're talking about. It's not costly, it's not expensive, because they're not building proprietary bilateral systems. So those were some of the incentives that broadly were at play to ensure that we co-opted everyone into the ecosystem. And then Sahamati sort of played a role to ensure that everyone's interests were represented in a very level playing field manner through various governance structures that were set up. So that's one question. Your second question was on this, what I would call like a gold copy, silver copy problem, right? Once you've shared data, what happens? How do they come back? So what we said is, look, fundamentally, at the end of the day, if you look at any financial transaction, or now if you generalize it to health or even government credentials, the gold copy remained with the provider. So I'm just sharing a digitally signed point-in-time version of that record with the individual. Now the individual can share that digitally signed point-in-time record with a lender. But tomorrow, if I apply for a loan, say 1 year from now, the lender is going to want to know my last 6 months' data. So I have to go back and get a refreshed version of that data to then share it with the lender. Or for monitoring purposes, once they've given me a loan, they want to monitor my cash flows. So in that case, again, I need to give consent such that that data is being shared from the bank or from the mutual fund with the lender in the future on a monthly basis or weekly basis. So that's sort of how we addressed the gold/silver copy problem. And then your third question was on, I think, data aggregators, right? Are they one, many? So what we said is these players are consent aggregators, essentially. They don't store your data. In fact, they're legally prohibited from storing your data. So the entities that store your data are all of these entities on the left. They are your custodians. But the consent managers, all they do is they just manage your consent. And when you give consent, they pick up that data and send it to the respective institution on the other end. That's it. So it's traditionally, like I said, because the internet was designed around ads required you to create these data aggregators and data monopolies. In this ecosystem, we said, let those remain, but we introduce the notion of consent managers that aggregate your consent and then facilitate the flow of data. So we separated, or rather we unbundled consent from data. So when you unbundle consent from data, let data remain wherever it is. If it's with an aggregator, let it remain with the aggregator, right? If it's with the credit bureau, let it remain with the credit bureau. As long as I give consent and that entity honors my consent to send data back depending on the terms of the consent. So I hope that answered your 3 questions. Yeah.
This is Gertrude Kadumbo from Malawi. Just following up on her questions, you answered the issue of the consent managers or the account aggregators not storing any data, but I just wanted to find out who regulates the account managers to ensure that there is compliance with all these legal and regulatory frameworks. The other issue that I wanted to find out was for the consumers themselves, before they consent to sharing any data or authorizing sharing of any data, do they get to know what data is being shared before they can consent? The other issue you also answered, I just wanted to find out whether this responsibility can be in the case of financial institutions. Can we extend the functionalities of the Credit Referencing Bureau to also play this role, because they are already sharing financial information with financial institutions relating to credit? The other issue I think you also answered, this was to do with incentives, to say, do the financial institutions just see this as a symbiotic kind of relationship where they feel that there's not going to be any incentive because there are more benefits that are accrued to them in the form of expanding the portfolio of their credit portfolios? Or as when you're starting to introduce this in a market, can you have some sort of incentives to the financial institution to incentivize them to participate and be in a position to share data? This can cut across other sectors of the economy, and not necessarily just the financial institutions.
Yeah.
Thank you.
Yeah. So maybe I'll answer your questions, but in no particular order. The last question that you asked, I think, so we discussed financial incentives that they have. We discussed business incentives that expands the market, hence it's profitable to participate. We discussed procedural incentives, reciprocity, things like that. The other incentive that also really benefited the ecosystem was the fact that additional sets of data were coming in. So the fact that, okay, GST, tax data was coming into the system, which meant now I could underwrite MSMEs, which I couldn't do before, was a very big incentive. The fact that other institutions were participating, so even if I had 30% market share, the remaining 70% of the markets coming on board, I may have lower costs of capital, I can compete on that. That became another incentive. Even if you look at capital markets, today India has about, we're 1.4 billion people. Largely most of our discussions are still banking focused, but there's been a lot of effort towards bringing more investors into the capital markets, strengthening and deepening that, which is key for a lot of emerging economies. Today we have only 1,000 advisors. So in a country of 1.4 billion, we only have 1,000 advisors that are assisting people to participate in the capital markets. Now, our regulator very recently made an announcement, can we go from 1,000 to 1 million? That will happen only on the back of account aggregator, because you will need automated advisory. If you have automated advisory, people will now purchase new types of mutual funds, etc., and that again expands the market for all of them. So really another incentive that benefited was the addition of other data sets, which traditionally they would have not have accessed in this safe, secure, convenient, and privacy-preserving manner, which also helped nudge them towards participating in the ecosystem. To your other question around who regulates and the governance, so these consent managers in the financial sector are regulated by the central bank, and that essentially the central bank is doing that on behalf of all the financial sector regulators. So there was an interregulatory directive that was passed, which included our capital markets, insurance, pension funds regulator, and the finance ministry. And they said our central bank would be in the driving seat. But in my view, I think these entities could also be certified Because many sectors don't have regulations. If you think about healthcare in India, you don't have one central regulator. Or if you think about private data, you don't have one regulator. So you could think of either your data protection board, or you could think of a certification scheme that ensures that the governance is being followed by that respective entity. It doesn't only have to be through regulation. Then to your point on the consent request, yes, it does have what is the data that's being asked for, which is what you see here. It's not very clear with the projector, but basically it reveals to the individual. And that's very foundational. What data, for what purpose, for what time period, but contextualized to the user. This could also be done in a voice manner, multilingual manner, non-smartphone based manner, all of those. Then to your other question of credit bureaus, so we have also 4 credit bureaus in India. The view was, rather than having them also be consent managers, they could participate, of course they can apply, but they are far better off actually being providers of data on one end. So now you have asset data, liability data that can come together, and also being consumers, because really their function is credit scoring. So let them focus on that. The credit bureaus initially did think of becoming entities in the middle. I think one of them even they created a subsidiary, if I remember correctly, which is a consent manager, so nothing prohibits them. But if you just look at it from an ecosystem level, it's far better for the credit bureaus to focus on creating better credit scores, better scorecards, better models that then benefits the ecosystem as a whole. And then you can have your startups really specializing on the consent experience. Nothing prohibits them. Like I said, one of them already is. But what we're seeing is that's a very specialized function. So it makes sense to have it separate. Otherwise, the same question would exist even to a bank. Why can't a bank do this function? So banks invested in companies that are doing this. They don't want to do the function directly because, again, it's a special function. Let the ecosystem have specialized players, scale it out across the country. The banks are just going to focus on credit risk and managing their balance sheets. Then you had one question on, I think I answered all. Regulator? Regulator we answered, credit bureau, consent, and the data types and incentives, yeah.
Thank you so much. Augustine is my name from Uganda. Just like my sister from Nigeria mentioned, this looks very interesting. Consent through aggregators. It looks a new concept because in this whole consent business, the assumption was there shouldn't be third parties. Why? Because consent is, you want to protect this data subject from their data falling into possession or access by a third party. So it should be from a controller who is a data custodian to the processor, a person who has requested that data. There must not be any intermediary there, especially if it is private aggregator. In this demo here, we are seeing a private entity standing in. And this private entity is seeking for specific details, which are also personal data. Because like we've seen in the form of, in the financial sector, they're asking you for your account details when you're creating account on the app and things like that, which is also personal data. And is being housed with a third party. How do we mitigate the risks that are associated with that third party that is in between? Number two, we are also cognizant of the fact that the more you create a longer chain, the more it becomes costly. Because this aggregator is not going to do the aggregation for free. They are going to charge a fee for maybe every transaction they facilitate. But we also know that this data controller, for instance, the person has been explaining that the whole concept, every authentication there's a charge. So charge the authentication, charge aggregation, before you know, it is a very ineffective process. So how do you control that ineffectiveness in terms of cost with this third party? Finally, in a number of jurisdictions, and I know India is one of it, this is one case for financial transactions. But there are other transactions that require e-consent. For instance, I will use the example of the education sector. Somebody wants to access my data that is maybe for credentials, academic credentials and things like that, which is personal data. I need to consent to it. So is this account manager who has been created for financial transactions going to be given leverage to also facilitate such other transactions? Or if you've been created as an account manager, aggregator for financial transactions, you don't cross boundaries. Thank you so much.
Yeah, very, very important questions, all three of them. If I answer the first one around the risks. So you're absolutely right. You're introducing a new intermediary. That intermediary plays a very crucial role now in the flow of managing your consent. If every data flow has to be consented to, they play a very strategic role in that ecosystem. So there are bound to be genuine, systemic, individual risks, sectoral risks that come up. So the way we've addressed that is at these three levels. One, the biggest risk was the customer itself was giving uninformed consent. So absent of this intermediary, because we didn't want to introduce a new player just like that, what is the current paradigm? I am running around and physically sharing data with absolutely no consent, even though our privacy legislation says there should be informed consent, or I'm digitally running around and giving my data all through WhatsApp and email and a whole range of sources. So the biggest risk was the risk of us not acting, because today all data flows were not consented to truly, if you actually analyze the data flow. So to address that risk is why we introduced the construct of consent managers. That's one. Second is then, okay, how do you ensure that the data is secure? So there are two things. One, again at the level of regulations, we prohibited storage of data. Then at a technology level, we ensured that every data flow is end-to-end encrypted with the concept of perfect forward secrecy. Meaning every time data is shared, a new key is generated and encryption is happening against that key. Now every entity in the ecosystem therefore then got certified against these technical standards. So you had risks. Those risks were addressed at a technology level. The other risk was, for example, the fact that, okay, do you create a central store of data? So we ensured in the technology the data is decentralized, yet I can bring it together for a particular transaction. So those risks of centralized data storage, the risk of the account aggregator being malicious, so the data itself was end-to-end encrypted, they can't look inside it. The fact that you shouldn't have just one entity doing this because then you create a concentration risk. We allowed there to be multiple entities. The fact that the ecosystem should ensure that as a customer I can go to any account aggregator, I am not locked in. So we baked in interoperability then across the technical and regulatory level. Then the ensuring on the consumption side, data was processed only in accordance with terms of that consent. There you needed the privacy bill to come in to ensure accountability, and if I don't, then complaints can be raised with the data protection board and penalties can be placed. So at every level, we looked at the risks that exist, and you can have many risks that can come up, and then looked at ways to categorically mitigate those risks across the board, largely using these three vectors of technology standards, various governance arrangements, and bringing diverse set of market players together. Another aspect was also consumer protection. How do you ensure that people, their privacy was protected? What happens around informed consent? There we created the construct called templates. So if I'm sharing data for a particular purpose, there is a set template that can be requested for. So even though I may not have, complete digital literacy and understanding of consent and all the connotations that it has, when my data is shared, it's only shared within that template. So for example, a lender cannot access my health data because that falls outside the template. So these were many interventions that were done across these three levels to mitigate those risks that existed. Then to your other question of the financial system, no, this is not just for finance. So like I mentioned, the same system is what's been implemented through DigiLocker for government data, and now with the passage of the bill for private data. So you can just imagine this. Don't do anything, please. You can just imagine this picture expanding with new categories of data. So now I can add e-commerce information. Now I can add telecom information using the same architecture. For that, we required the privacy bill to come in, and our parliament very recently passed that. So you can have different types of information beyond just finance. So this is not designed only for financial data. You can think about this, like I said, for government and other types of credentials, education and skilling credentials. All of that requires a customer to give permission to then share that with whomsoever they feel like. And to your third question of cost, that is extremely important. So the way we looked at cost, if I again go back, one, what we ensured is when you introduce this new intermediary, the entire base architecture is interoperable. So oftentimes you have high costs because you have to create proprietary integrations with exclusive relationships, right? So imagine this entity would have to go and partner with a bank, and then the bank will get into some exclusive partnership, and then another entity will go and partner with another bank, and that's really going to raise the cost in the ecosystem. So we ensured that the base architecture was interoperable. By ensuring the base architecture is interoperable, if I look at the costs of running this business, those costs are purely consumer acquisition costs. Because when I participate in the system, I'm automatically connected to all the participants in the network because it's interoperable. It's legally and technologically interoperable. So I'm not incurring a cost in having to go to each financial institution and say, please partner with me, please sign an agreement with me, I will give you X or Y in terms of revenue. So that interoperability, I think, drastically reduced cost across the system, and that cost carried forward even when they had to do certification, audits, purchase technology to participate in the system. Now you had multiple providers that could provide that technology because it is an interoperable architecture. So I can just go to the market, buy from a competitive set of players, or build it on my own. So your base costs are actually quite minimal in this structure. The account aggregators therefore only focus on consumer acquisition cost and facilitating the flow of data, which is all electronic, so that's quite minimal. And this is happening within a regulated system. So yes, if you find the pricing actually going, too high, the regulator could potentially step in if they see some of those dynamics play out. Right now we see the other dynamics. It's trending towards zero, right? So it's a problem on the other side, not really a problem of higher costs. Yeah.
All right, hi. I have a two-part question. So the first is, well, you'll have to answer it if I ask the next one, right? So can a user use multiple consent managers, right? And, well, maybe answer that first. Is that yes or no?
Yes.
Yes,
they can.
okay. So then here's the question. Can a consent manager see existing consent, like so historical consent, right? And if that's a yes, then where is that stored, right? I could go on, but if the assumption is that it's stored with the providers, because I assume it's an open system I can query, right? But you mentioned earlier about IDs being a consent ID. It's kind of leaning itself back into one type of verifiable ID, because how will I know the user across? You see where I'm going? So how do you manage that, where as a new player, I'm a new consent manager, I have a great app, I want to drive adoption, and so I get a user, but I want to be able to bring on their history as well. Where would I find that history?
Yeah, so essentially the history is localized to each consent manager. Think of it like email, right? So you're building a new email client. I use Gmail, right? And you're building a new client, say ABC, very privacy preserving one, unlike Gmail, which may make money from my email data. And you're coming to me and saying, hey, why don't you move over? So fundamentally, the consent history is localized to each consent manager. I have a choice which one I want to select, and I can use multiple at a point in time, one to manage financial data, one to manage health. But that history of all those transactions is localized to that consent manager. If I want to move to another consent manager, let's say you're a new one that comes on board, I can always port my consents, right? Just the consent history if I want a common view. But for you as a new consent manager, because the base architecture is interoperable, you think of it just like email, you can plug in and automatically you will be live with the entire ecosystem. So you don't have to go and do custom integrations again with each bank, each institution, each company, either as providers or as consumers. So you can create a new consent manager, get approved, automatically you get connected to the network because it is interoperable, and then go out and acquire customers depending on whatever is your pitch. And the customers, if they so like, can always port consents, like you can port your previous email IDs, but then every new email / every new consent happens on your system, and it's localized to that system by design.
Okay, thank you.
And I could even store my consents. One of the things we designed in the protocol was I could even store my consents on my device. So it doesn't even have to be stored in the consent manager's server. They could offer a higher encryption experience, and that's just stored locally on my client. It's up to them, really what experience they go ahead to build out, but those are innovations that are possible on top of this. Thank you so much. I think that's it, right? I'll just take a picture.
Thank you so much, Siddharth.